Welcome to our end of financial year market update. Today I have Matthew Jeremy with me. Matthew is our Senior Portfolio Manager, and today he's going to answer some key questions on market and portfolio performance and then finish with an outlook for the next financial year. So welcome, Matthew. The first question I have for you is 2018 and 19 was a big year for markets and investors. Can you tell us what happened?
Thanks, Andrew. It was a dramatic year indeed, and very much a year of two halves. Second half of 2018 saw the world economy suddenly start to slow down quite significantly under the weight of higher interest rates in the US and weakening growth in China. Markets became concerned that a recession was around the corner. Equity markets in particular fell dramatically. All of this changed very quickly from the new year when the Federal Reserve backed off on the interest rate increase story, and markets started to aggressively price the chance of interest rate cuts, not just from the Fed, but from other central banks around the world, including the Reserve Bank. Equity markets and bond markets responded very well to this and rallied hard in the second half of the financial year.
And how did this influence portfolios in 2018 and 19?
Andrew, there are three key messages here. The first is to do with asset allocation. Now, it's important to remember that our portfolios are multi-asset portfolios, not just equities. We adjust the mix of the assets as market conditions require. So what did that mean for 2018-19? Well, first, in the second half of 2018, as interest rates were rising and equities were going down, we had positioned the portfolios to be underweight in equities and bonds and overweight in cash and alternative investments like hedge funds. But then as the story changed in the first half of 2019, interest rates flattened out and equities were rising again, we changed the allocation so that the portfolios were overweight equities and bonds, both benefiting from the different interest rate structure, and underweight cash and alternatives. Now, this dynamic asset allocation worked well for us in 2018-19. We were able to steer a path through equity market volatility to deliver returns and protect client capital against downside shocks. Now, what this means is that portfolios should be able to beat equities in down markets, but not so much in strong up markets. And that's exactly what happened in 2018-19. The second key message is to do with the performance of the growth stocks. So 2018-19 was another big year for growth stocks, especially the well-known tech stocks overseas, the so-called FANGs, and here in Australia, the popular WAX stocks. These stocks have become very expensive relative both to their fundamentals and to the rest of the market. The chart on the right, courtesy of Antipodes, shows the relative performance of growth stocks and value stocks. Basically, the blue bars on the right-hand side of the chart show the extent to which value stocks have underperformed growth stocks. History shows that these sorts of extremes of valuation tend to reverse. Not holding these stocks caused a performance drag on portfolios relative to the equity benchmarks. What's important to note is that that effect was not an isolated occurrence amongst just a few asset managers. It was in fact a much more widespread phenomenon in the Australian equity market, which leads to our third key message, Andrew, active management. 2018-19 saw active Australian equity funds struggling to beat the benchmark. The chart on the screen shows the proportion of funds able to beat the benchmark over rolling 12-month periods over the past decade. As the shaded blue area on the right shows, the number of funds beating the benchmark over a rolling 12-month period declined sharply in 2018-19, to the extent that only 10% of the active fund managers in the market were able to beat the index. That is, 90% of active equity funds underperformed. Factors behind this include the impact of the tech stocks we mentioned a moment ago, and related to that, the rapid rise of funds flowing into index funds. These conditions are starting to reverse as the growth of index funds peaks, and as we've noted, the expensive valuation and outperformance of the tech stocks is not something that lasts forever. The good news is that we expect the performance of equity managers to improve in coming months.
Thank you, Matthew. And what is the outlook for markets and economies at this point? And what are the key risks we should be thinking of?
Andrew, the investment landscape has changed dramatically in recent months. We are now very much in a world of low growth, low inflation, and low interest rates for some time to come. And I don't just mean a few months, but a few years. However, on the brighter side, recessions do not look imminent either here or in the US. In this environment, we expect central banks, including the Reserve Bank, the Fed, the ECB, to cut cash rates even further. So we're expecting to see the cash rate here in Australia below 1% by the end of the year. This low interest rate, low bond yield environment is going to keep driving investors to chase yield in equity markets. An important development that we're keeping an eye on is that fiscal policy will have to do more in order to support economic growth. We're seeing some signs of that already here in Australia, and we'll be looking for more of that. Portfolios in this environment need to be very well diversified, and they need to be flexible in their allocation between assets. Some of the risks that we're keeping an eye on include the trade dispute with China, not just between China and the US, but between China and the rest of the world. We think this is a process that will take some years to resolve, and from time to time we'll see bouts of volatility as progress looks to be slowing down. In the UK, of course, we have a new Prime Minister, and Brexit is supposed to be sorted out by the end of the year. If the UK does in fact leave the European Union, it is entirely likely that there will be another vote for Scottish independence very soon afterwards, and we would not be surprised to see that vote succeed. Also on the political front, we expect to see more populist politics in the US, the UK and Europe, which will cause volatility in markets from time to time.